Hey there, Ron Gula from Gula Tech Adventures, and in this VC 101 video, we are going to discuss financial modeling for startup tech founders. Now, as president of Gula Tech Adventures and having co-founded Network Security Wizards and Tenable Network Security, I've been where you are. If you're starting out right now and wondering, how do I plan? How do I go forward? What risk should I take? It all comes down to knowing how to run a business. So it's called financial modeling. So I'm going to talk about this from the point of view of your first $0 to $1 million in revenue, all the way up to your $1 to $10 million in revenue. The biggest thing I want to impart on founders, though, is that, look, when you start out, you have no customers and you have no money. You probably get a little bit of funding from maybe a rich uncle. Maybe you can invest a little bit into the company, but you're basically going to have to get investors to help you build the company. In this stage of the company, you're basically working for the investors. The investors might not own any stock in your company. They might own 5%, 10%, but if you are dependent upon those investors, you might have to go back to them and ask them for more money. That dependency is what you want to shift away from. You want to instead become dependent upon your customers. You want to basically be making more money than you're spending to run your company. And this is, of course, how you grow and what you do. Now, this transition, a lot of founders never really get. We get a lot of pitches at Gula Tech Adventures where there's a dramatic hockey stick. If we only invest maybe $1 million in their seed round, they're going to be doing $10, $20 million in the future. In reality, we tend to see a lot more companies who've raised a lot more money than they've actually made from their customers. Now, a lot of different models. We've talked about other type of models on the channel. This is for starting out in the basics. All right. So the first thing you need to realize as a startup founder is that you have to keep track of your income and your outflow. You have to basically be very aware of your cash flow management. If you're a founder, you can't leave this up to a co-founder. You can't leave this up to your finance person. You can't leave this up to somebody who you've outsourced. You have to know almost down to a T what your cash flow balance is and when you go below zero. Now, there's a lot of ways to look at this, and we'll talk about that, but you'd be surprised how many founders I speak with who have no real idea of how payroll, taxes, paying for insurance, paying for benefits, paying for rent impacts your daily cash flow, or what happens if a customer is going to pay you but they delay that payment 90 days. Are you going to tell them, oh, no, you can't have the product? Almost every founder I talk to is, they want to take that money. It's really, really important. So having an understanding of cash flow management is really, really important. Now, how detailed can you be? You shouldn't have any predictions on there. You should only do things that you know are real. Accounts receivable, that's money that customers have committed to, minus your things that you're going to be spending on. You should be able to put this on a spreadsheet and project when you run out of money. Now, that's the second thing. What is your cash runway? This is also something that every startup founder should need to know. This is a sensitive topic, but it's also something that you need to understand you're going to have to share perhaps with some large customers and perhaps even with investors. They're going to want to know. You can't go through an investment process and say, oh, we're doing great. We've got $8 million in the bank. And then you don't, right? Maybe you have 8 months left and then you're out of money. So understanding your cash runway is a very important thing, and understanding who you share that with, whether it's an employee, your executive leadership team, your investors, your banks, you need to be consistent in that messaging. And if you have dramatic changes to that, you might have to make dramatic changes to your company, including not hiring, not expanding, not spending money on marketing, not going to conferences, possibly even terminating people or even closing down a physical location if you happen to have one of those things. So understanding your runway is a really, really important thing. Now, the second thing you really need to, or the third thing you really need to understand is budgeting and forecasting. Now, this is where you can actually make a little bit more wiggle room and guesses. And this is the risk you're taking as a founder to run your company. How many new deals are you going to get in the next 6 months? Well, if you sandbag and you're very conservative, you assume zero, guess what? You're probably going to be able to predict and have money left over in the bank. But if you think that you're going to be making another $5 million and you make $5 million worth of investments, you're risking not doing that. Balancing this risk is a really difficult topic. A lot of people I talk to say, look, as a default alive, you need to have 18 months of runway if you've been up and running for a while. If you're starting out, you might have 18 months of runway because you've raised a little bit of money and you haven't hired anybody yet. But having the ability to forecast both windfalls from successful customer engagements all the way to making investments in engineering and marketing and people inside your company, that's where you get into some budget and forecasting. And this stuff is perfectly reasonable to share with a potential investor. A lot of times I talk to founders and they're like, look, I can't share this kind of stuff because it's very sensitive. It's really my innermost workings. This is pretty much you want. You want to have somebody who's not only willing to write you a check, but take the same calculated risks and understanding those risks that you're making. We talk to a lot of founders who don't have any sense of this at all, and they think we're prying when in fact you really want to make sure you are aligned. There's a lot of different investors with a lot of different risk tolerances, and you want to have one that's going to be aligned with your values and what you're taking. So another thing you need to consider is revenue models. And this revenue model is basically saying, look, you've started your company, you've got an idea of the technology you want to bring to market, but what are the chances that you're pricing it and you're selling it in the correct way? So how do you opportunize, or how do you actually take advantage of opportunities? Maybe there's smaller businesses who can't afford as much of the price of what you're doing. Maybe large enterprise doesn't want to buy the product as a technology. Maybe they want it as in a consultative engagement. Unless you know how your company is working, unless you know the inner workings of how much it costs to make a product and what the value customers are having, you are not going to be able to evaluate other revenue models. So I'll give you a couple examples. When we did Network Security Wizards, we sold the Dragon Intrusion Detection System. It was a piece of software. And back in the late 90s, you bought the software and you had that maintenance. People didn't want to buy a subscription in the late 90s. This was not something that was very, very common. What they did want to buy was appliances. So we were able to figure out a way to sell appliances and the software in all one bundle, because that's what people wanted. They wanted one part number and something that was there. When we were doing Tenable Network Security, we went through several major licensing changes. One of the big ones was that we were selling the Security Center product, which used to be called Lightning way back in the day. And we sold it on a per user basis. So you bought for the number of users for your organization, unlimited IP addresses. Guess what? People bought one user account and they scanned everything and they shared that. Of course, now it's sold on a per IP basis. Now, the other thing that we did at Tenable is we moved from perpetual licensing to subscription licensing. We went from basically selling a piece of software that had a certain version and maintenance that went with that, and we converted that over to a subscription model where people just paid on an annual basis, and they got free upgrades during that. And that's a big change. Now, today, we've got all sorts of models that are out there. There's the big thing that I've seen with startups right now is they seem to have issues with separating, trying to create a freemium or sort of a community user groups of people using their product for free, and then encouraging them to buy the commercial version of that product. Trying to get that licensing mix down is really, really difficult. But anyway, if you're sitting there with your founders and your executive leadership team or potential investors, and they're saying, oh, you should sell the product this way, you should sell it through the channel, you should sell it through managed service security service providers, that sort of thing, it's really hard for you to make those decisions and those risk decisions on that unless you know the fundamentals of your business. Now, these fundamentals of your business are how people judge you. And this is an interesting thing because most of what I just talked about was before your first $1 million in revenue. But somewhere between $1 million in revenue, whether it's annual recurring revenue or just $1 million in revenue and $10 million in revenue, you are going to have to increase the sophistication of your financial planning. And you're going to have to do this for a couple of reasons, because as you get bigger, it's not about how well you're running a company. It's about how well you're competing with your peers. And let's say you're going out for, you want to sell your company, and you might think you're doing great. You've got the best mousetrap out there, and you're selling it, you're profitable, you're running a good business, your employees are happy, you're doing great. Well, that's not why people get acquired. People get acquired because you have better technology or better businesses. So someone who's thinking about buying your company is going to evaluate all the mousetrap vendors that are out there. Maybe somebody has just as good of a mousetrap as you do, but you've cracked the code for selling it to home users. You just own the home user market. Maybe somebody has the same mousetrap technology that you do, and they own the mouse exterminator business. Those are sort of reasons to buy a company where they understand your business. And the kind of tactics and KPIs, which are things people use to track your business, are going to be like, look, what is your cost to acquire a customer? They're going to evaluate you on that. So even though you might have a great business, you're profitable, your employees are happy, you're spending maybe twice as much to make a customer happy as perhaps your nearest competitor, or maybe you're doing it half as much as they are. Now, another thing people are going to judge you on is your cost of goods sold. At the end of the day, maybe you sell the best mousetrap out there, but your mousetrap costs 50 cents for you to build, and a competitor's mousetrap costs $1. Now, maybe your both mousetraps are the same, but yours is obviously a more scalable and sustainable business. Now, when you think about cost of goods sold, you need to add up all of your business. You're basically going to take your revenue, you're going to subtract it from the cost of operating the business, and that's a way you can start looking at your cost of running the business. You divide that by the number of products that are out there, and you can compute those things. Now, with more sophistication, you can talk about your engineering cost, your marketing cost, your sales cost, and this is where a professional accounting and finance team can help you think about those things. Now, the more you have access to that type of information, the better you're going to be at predicting and running your business, right? So if you want to understand cash flow, if you understand new revenue models, if you want to understand, how to make those risks and projections out there, you need to understand those kind of basic things about your business. Now, a lot of founders out there don't spend the time to do this. They focus on the tech, they focus on the customers, and you need to do that, but you can't forget that third leg of running a business, which is operating the business. I was very lucky to have my wife, Cindy, at both companies, who was really good at the initial days of spreadsheets and that, as well as Jack Hoffer. Jack and I, we co-founded Tenable with Renault, and the four of us, we had a great time always putting stuff down on spreadsheets, always kind of predicting what would happen, and always having a vision of what could happen in the next 12 months, 18 months, that sort of thing. And you need to do this as a technical founder. Now, the last point I'm going to make is, as you raise money, if you are selling stock in your company, something you need to always be considerate of as a founder is who has control of the company. This is called your cap table. This is basically how much stock is in the company and who owns what stock. And guess what? People who own more than 51% of the company, more than 50% of the company, tend to own the company. Now, there's a lot of potential things you can agree to from a board governance point of view. But the point is as you're predicting down the road, not only do you have to think about, am I running my company, but am I also going to be, the CEO and the founder who's making all the decisions? And if that's something you want, that's something you have to optimize for. At the same time, though, if you really want to make your company the best thing out there, you can hire CEOs. And I always tell people, you're still the founder. The CEO kind of works for the board at that point. It's a different model. I've seen a lot of people struggle with that. I've seen a lot of people really, really succeed and do well with that. All right. So last thing I'm going to leave with you is that the first thing I said, who are you working for? You want to shift from working for your investors and being dependent upon your investors to working for your customers. You want to be making more money from your customers. You want them to be happy. You want your employees to be happy, and then you want to reinvest that in the growth of your company. This transition is everything we've talked about with financial planning. Now, there's a lot of smarter people out there on all these topics, but if you're a founder, this is some straight talk on how you should be thinking about getting going and some of the obstacles you're going to find as you grow your company, which can become opportunities if you manage them well. I'm Ron Gula. Thanks for watching this. If you've enjoyed this VC 101 video, check out all the other videos we've done, which talk about everything from raising money to basically naming your company, even to dealing things with like, should you do NDAs when you're a small business? Have a great day. Thanks for watching. Give us a like if you enjoyed this.